What's up, guys? It's Graham here. So this is absolutely crazy. Over the weekend, President Trump tweeted, and I know I might get some pushback for saying this, but to me it's obvious. A 50-year mortgage is an absolute disaster waiting to happen, and no one should ever take that option. Ever. In fact, a 50-year mortgage is completely uncharted territory, and if one thing goes wrong, it could completely devastate both the housing market and the borrower. So let's talk about the actual math behind getting a 50-year mortgage, if and when it ever makes sense, and my own thoughts as someone who's been in real estate since 2008. Because I gotta say, most people have very little understanding with how this works and why it's a really, really bad idea. Although before we go into that, if you appreciate videos like this, where we just cover the facts, it would mean the world to helps out tremendously, and as a thank you for doing that, here's a picture of a baby polar bear. So thanks so much, and also big thank you to Helium Mobile for sponsoring this video, but more on that later. Alright, so to start, let's talk about where all of this begins. The 30-year mortgage. For those unaware, this was initially created in the 1940s as a way to help finance the construction and sale of new homes after World War II, and then by the end of the 1950s, it was adopted throughout the entire market as a way to incentivize families to build long-term equity. Well, wouldn't you know it, these days, the 30-year mortgage has become so popular that more than 90% of buyers pick a 30-year term on their mortgage. Now, obviously, there are more options today for buyers to pick from, like an adjustable rate mortgage, interest-only mortgage, 15-year terms, and so on. The options are pretty limitless, but the 30-year term is often seen as the safest. It offers the most flexibility, the most stability, your price is fixed until the home is paid off, and if you qualify, they're pretty easy to get because almost every bank offers them. However, there is a bit of a catch, because your interest payments are front-loaded towards the beginning of the loan. For example, with any fixed-rate mortgage, your monthly payment is split into two parts: principal and interest. In the beginning, most of your payment goes towards interest because you still have the full loan balance, and so very little of your monthly payment actually pays down the loan. But as time goes on and your loan balance gets smaller, more of that payment begins going towards principal, and over time, you could finally start building equity. Like this chart really shows it perfectly. As you could see, at first your monthly payment consists of almost all interest, but by the time year 20 comes around, this flips to the point where most of your payment becomes equity, and that's where things get very interesting. See, the typical person only keeps their home for an average of 12.3 years, meaning on a 30-year loan at 6% interest, they've barely begun to pay off their mortgage by the time they sell the home, get a new loan, and start the process over again. Even if they kept the home for the full 30 years, they will have paid $1.2 million to buy that $600,000 home 30 years earlier. So why don't more people go for the 15-year mortgage? When you look at a 15-year mortgage, you're going to notice that your monthly payments are significantly more expensive. And here's a real example of a $500,000 house, 6% interest, 20% down. If you pick a 30-year mortgage, your monthly payment's going to be about $2,400 a month, and a lender will qualify you for that payment if you make about $7,500 a month, or 3 times the mortgage payment. Pretty simple. However, if you get a 15-year mortgage, your monthly payment's going to be about $3,300 a month, which is going to require you to have an income of $10,000 a month in order to qualify. So what do most people do? That's right, they choose the lower priced option. It allows them to qualify with less income. It allows them to qualify for much more home. And all things being equal, they would be able to increase their purchase price by 34%. Which is a lot. Like, that's the difference between you buying a $500,000 home and a $670,000 home. And even though, sure, with a 15-year mortgage, much less of your payment is being eaten away by interest, for most people, the 30-year option offers more flexibility, it's easier to qualify for, they could get a bigger house, they have more options, and so they go for it. That's why most people think, oh, a 30-year mortgage is so much less money every single month than a 15-year mortgage, so a 50-year mortgage must be even better, right? Well, that is where most people are 100% wrong. So let's talk about the 50-year mortgage. Over the weekend, Trump tweeted a photo of President Roosevelt on the left, who helped standardize the 30-year mortgage, while on the right, Trump sits with a 50-year mortgage. Initially, my first reaction was, why on earth would this ever be a good idea? Because it makes mathematically 0 sense whatsoever. But surprisingly, people seem to be rather excited about it. Like, we already have 144-month car loans and buy now, pay later for Chipotle burritos, so why not extend that to a mortgage to hopefully lower your payments? Even the developer Pulte retweeted this by saying, thanks to President Trump, we are indeed working on the 50-year mortgage, a complete game changer. Which, for those unaware, Pulte Homes is one of the largest national developers in the United States, having built nearly 1 million homes. So if they offer a 50-year mortgage term, people seem to be in favor of this because they think it'll help them lower their payments. They think they could qualify for a bigger house, and they think it'll help keep the real estate market strong. But mark my words, it won't. It's a bad idea. Anyone who understands math will agree with me. So as far as the actual numbers behind this, and what it actually means for anyone who gets one, here's what you came for. Although before we go into that, if people are out there signing 50-year mortgages just to save a few bucks every month, you may as well save money in other areas that just make more sense, especially heading into the holidays. That's why it's so important to find ways to cut back without feeling like you're actually cutting back. And one of the most overlooked options out there is your cell phone bill. Like, the average person is spending over $100 a month, but you could be paying nothing thanks to Helium Mobile, who I'd like to thank for sponsoring this video because they're a genuinely incredible service. For those unaware, their plans start at just $0 a month, as in totally free with no contract, no credit card, and no hidden fees. It's perfect for light users or those who want a second line. Or if you want unlimited data, that is just $30 a month, again, with no contracts whatsoever. Not to mention, if you have kids, they also have a plan for them that's only $5 a month that comes with 3 gigabytes of data and unlimited texts and calls, while you stay in full control. On top of that, Helium Mobile also pays you back in cloud points for doing simple things like referring friends or actively using your cellular data. And those points could be redeemed for gift cards to places like Amazon, Apple, Sephora, and more, all from within the Helium Mobile app. This means you could finally budget for the holidays without overpaying for your cell phone plan. And all you have to do to get started is sign up for Helium Mobile down below in the description and use the code GRAHAM to get $10 in cloud points for gift cards just for signing up. Again, the link is down below to start saving today. Thank you so much, and now let's get back to the video. Alright, now here's the math that no one is telling you when it comes to the 50-year mortgage. Even though going from a 15-year to a 30-year mortgage will improve your affordability by 34%, which is a lot, going from a 30-year to a 50-year mortgage improves affordability by less than 8%. Yes, you heard that correctly. Getting a 50-year mortgage will make almost no difference whatsoever, except you're going to be taking on way more debt for your entire life. And if you don't believe me, here's some of the math. First of all, it's important to mention that overall, the longer of a loan term you get, the higher the interest rate is going to be because lenders want to be compensated for tying up capital for longer. Like right now, it's 6.125% if you want to get a 30-year fixed rate mortgage, but it's only 5.375% if you want to get a 15-year. So I promise, with a 50-year mortgage, you'll wind up paying closer to 7% because there's significantly more risk. This means if you get a $500,000 loan at 6% fixed for 30 years, your monthly payment's going to be $3,000 a month. But if you think you're about to save a ton of money stretching out your payment to 50 years, well, guess what? At a 7% interest rate for 50 years, your monthly payment's going to drop to, wait a second, $3,008 a month. Wait, it actually gets more expensive? Yes. In fact, even if the interest rate is the exact same on a 50-year mortgage as it is on a 30-year mortgage, which is mathematically impossible, by the way, but just for the sake of the argument, let's just assume that aliens have abducted everybody and we live in an alternate universe where that is the case, your monthly payment would drop from $3,000 down to just $2,632 a month. To put that into perspective, that's basically the equivalent of you saving 10% on your mortgage or being able to qualify for a home that costs 10% more. That is it, for nearly doubling the time it takes to pay off the loan in the first place. And like I said, the realistic savings would be pretty much non-existent because there is no way that they could offer a 50-year mortgage term at the same rate as a 30-year mortgage term unless it's subsidized by the government or it's just baked into the purchase price. And if they do that, we're all going to end up paying for it in the form of higher prices and probably higher taxes. Not to mention, there is another concern with all of this, and that would be investors. Here's the part that nobody talks about. 30-year mortgages are only viable because most people keep their home for about 10 years and then they sell their home, the loan gets paid back, and then they start the process over again. That is why mortgage rates are so heavily tied to the 10-year treasury yield. Essentially, the two are interchangeable. So when mortgages are bundled together and sold on the secondary market, it gives investors a stable return that they could count on, and it provides more liquidity back into the markets immediately to go and issue more loans. On the other hand, a 50-year loan holds a massive risk to whoever buys and holds onto that loan. Why? Well, here's the math. If you buy a $550,000 home, you put 10% down, and you get a 50-year loan, and then you sell your house 12 years later, because most of your mortgage payment is front-loaded with interest, by the time you go and sell it, you've paid off just $32,000 worth of principal. This means if your home doesn't meaningfully go up in value and you sell for the same price that you paid for it, subtract 6% for closing costs, subtract what you have remaining on your loan, and all of a sudden, you've now got less than you put down to buy the property, all for the risk of owning a property in the first place. Now, even though the reality of your home being worth less 12 years from now is unlikely, it does create a very dangerous scenario where if the market goes down by any amount, you're quickly going to be underwater on your loan. And in the event you can't get more than what you paid for it, you're quickly going to be left with nothing to show for it even after holding your home for more than a decade. This is why lenders inherently need to charge more interest up front, because the loan is riskier, and it's riskier for the buyer to lose money on the deal. In fact, it's also a double negative for banks, because if they give a 50-year loan and interest rates go down, the buyer just refinances. But if interest rates rise, now the bank is stuck with a low-yielding investment for many, many, many decades, and they're going to lose a lot of money on that. That's why, feasibly, a 50-year mortgage just doesn't make any sense for anybody. Not the banks, not the borrower, not the investor. The reason a 15 to 30-year mortgage works so well is because that increases affordability by 34%. But once you go beyond 30 years, there are diminishing returns, and the net benefit for going from 30 to 50 years just isn't there. It's not practical. Not to mention, banks probably don't want to issue loans that you're not going to be alive for by the time you should be paying it off. Unless, of course, it's subsidized for the government or baked into the selling price, at which point, again, we got bigger problems. Plus, on top of all of that, by law, a qualified mortgage is not allowed to exceed a 30-year term. These qualified mortgages are very important because it gives the lender recourse in the event the borrower defaults on their loan. And because those loans are less risky, they're able to charge less interest to the borrower. On the other hand, a non-qualified mortgage does not have that shield, and the liability falls back on the bank in the event the borrower stops paying. That's why I'm saying there's no reasonable way that you can offer a 50-year mortgage at the same interest rate as a 30-year mortgage without paying substantially higher interest up front. It just doesn't make any sense, and at that point, it completely defeats the purpose to begin with, because if you pay more than like 10% higher than you would with a 30-year, you start paying more on the 50 than you would with the 30, even though you're reducing the payments because you pay more interest. It doesn't make any sense. Like, if you want my take on this, if this actually has any chance of passing, it's probably going to be a very specific loan product, issued most likely by developers who could just bake it into the higher purchase price. It is going to be issued on a case-by-case basis, and it's going to require completely changing housing laws to enact mortgage protections on banks. Not to mention, it would need to be assumable by people who want to keep the house in the family, because otherwise you have people taking on 50-year loans just so their kids could keep paying off the loan, and then eventually the kids die and the grandkids hopefully inherit a paid-off house 100 years later. To me, all of this is just a bit of a gimmick. Like, it's fun to think about, it gets people talking a lot on Twitter, but mathematically, it makes no sense to take this over a 30-year mortgage, and there would have to be major hurdles to overcome just to get this out there in the market. Separate from that, I think, in terms of actually making a difference in the housing market, all we need to do is unlock more inventory, and to do that just requires really three things. First, increase the capital gains exclusion from $500,000 to $1 million for married couples, and then increase it every year with CPI. This will incentivize way more sellers to list their homes for sale. And that would have been the inflation-adjusted amount anyway from the $500,000 that was enacted back in the 1990s. Second, they should also allow you to take your existing mortgage with you and apply it to the next home, assuming you're trading up on a primary residence. And this would also unlock a lot of lower-priced inventory. Three, we should allow people to write off up to $1.5 million of mortgage interest, but only for new loans that are issued after 2026. But beyond that, let me make this very clear. A 50-year mortgage is a very dumb idea. It mathematically doesn't make any sense to take. I think it won't even work. It's not going to make any difference for housing affordability. And if people actually go for it, we have a problem, especially when the average home buyer is 40 years old. I guess they just pay for their home until they're 90? Great, just in time to go to the nursing home when their kids could qualify for a 100-year mortgage.